Good morning, everybody. Hope you had a wonderful weekend and you're set for the week. Welcome to the Monday morning call. So any questions, concerns, make sure you type them in. We'll be happy to address them. Otherwise, we'll get started. So I just want to bring up a couple of things and bring us back to reality. This is the U.S. economic growth rate since 1948. So let's see how many of you can read a graph. What's happening to our growth rate? It's slowly doing what? Which makes sense. I mean, for a developed country, eventually it's going to what? Go down. So, well, how does that affect us? Why would I even bother showing this? Well, how should that affect our expectations for our clients? How can we, what should we be sharing with our clients? Cautious about what, though? I mean, what's this going to affect? If the GDP goes down, how does that affect our clients? Returns on investment, Trevor, exactly. So, I mean, every single year it becomes more and more difficult for us to see the same kind of returns we've had in the past because of GDP. I mean, the stock market hopefully is based on the profitability of companies, and profitability of companies are based on the economy growing. If the economy is growing slower, then the profits are going to be slower, and companies are going to be slower, and the stock market is going to go up less. So this, I mean, all these, I mean, this is what academics show us. This is what governmental agencies, this is what the academics show us. But what do anybody who sells stocks want us to believe? What does anybody who's selling stocks, so Wall Street and all the analysts that get paid by Wall Street, what do they want to show us? What do they want us to believe? That what's happened in the past is going to continue to happen in the future. And I do think the stock market's going to go up. Yes, I do. But I don't think it's going to go up in the ways that we are used to it going up, and every year it becomes a little bit more difficult. The other thing I wanted to show you is this. I can get the next. What is this? What is this telling us? So somebody who's excellent at reading graphs, what does this tell us? We certainly experienced this in 2008 and 9. What's it telling us? That the whole theory of what is out the window. The whole theory of what is out the window. Decoupling, no diversification. Yeah, so the whole theory of asset allocation is what? Easier than it used to be or more difficult than it used to be? So it means we're going to have to be even more cautious since diversification is becoming very, very difficult since the correlation of real estate, I mean, basically of everything, is coming closer and closer together. So the first thing I want you to understand is I love stocks. Half of my money is in stocks. Half of my clients' monies were in stocks. I love stocks. Okay, so don't get me wrong that I'm down on stocks and think everybody should have their money in safe vehicles because we need to be in stocks for growth. But along with that, I want us to keep calm and don't expect too much. So what do you think I mean by don't expect too much? What do you think I mean by don't expect too much? See if anybody can get what I mean by don't expect too much. Yeah, returns, double-digit return, yeah, all those things. So I love stocks, and we need stocks to keep ahead of inflation, but the fact is don't expect too much. And it drives me bananas when I talk to advisors who talk about this fantastic system, fantastic money manager who's finally figured it out, how to get great returns and miss out on the downsides of the market. Guys, how long has the stock market been around? Hasn't anybody yet figured out how to do that? Has anybody yet, out of thousands and thousands of very intelligent guys, been able to figure out how to get higher returns and basically mitigate the risks? Nobody's done it yet. So why would I believe anybody can do that? Why should I believe anybody if nobody's done it? And here's the thing. 75% of all trades on the market are being done by 50 of the largest stock trading companies. And they have, who works for those companies, guys? Who works for those companies? Do they hire schmucks or do they hire the brightest of the bright? And do they have computers beyond programs? And guys, did you know that these companies, they have moved their physical plant closer to Wall Street? Why? So they can get a trade in even a microsecond faster than everybody else. So if 75% of the trades are coming from those people, the only way we can beat them, and first of all, have any of them been able to beat the market? Have any of they been able to beat the market? No. So if they can't beat the market, and we have to, with all that brain power, computer power, how can we expect to beat the market? We can't beat the market. So all we want to do is what? At least get what the market gives us. But don't get into the whole mindset that you're going to beat the market or get great rate of returns with less. Don't expect too much from the market. The market is designed to do what? Why do we invest in the market, guys? What is the only reason we invest in the market? Like I said, I got half my money, inflation, right. I got half my money in inflation. My clients had half their, inflation. I got half my money in the market. My clients had half their money in the market. So I had it there to keep ahead of inflation. But guys, can I ask you a question? For our retired clients, if they're relying, if they have not retired with enough money to retire, and they're relying on the market to grow them out of the fact that they don't have enough money, what are they in for? If they retired with not enough money and they're hoping to grow themselves out of that problem, what are they in for? They're in for trouble like you wouldn't believe. So really, our clients should have retired with enough money, and then the only reason we have them in the market is, as you said earlier, to keep them ahead of inflation. So what we need to do is just not expect too much from the market. So we want it to grow. We want our clients' assets to grow, but we want a big chunk of it and guaranteed. That's why I want to see our retired clients' assets, at least half of it in, guaranteed, and then let the other half grow. But don't try to mix the grow with the guaranteed. Guaranteed is guaranteed and grow is grow. Don't try to mix my growth where I'm going to say, I'm going to try to get great rate of returns but mitigate the risk. No, don't try to do that. And don't even talk to the clients about that, because that's a losing game. Nobody's ever been able to do that. And well, no, I take that back. There's been lots of people who have been able to do it once. There's been lots of people who have been able to avoid the downfall once. But what has nobody been able to do, guys? Constantly, I'd even say, Tony, not only constantly, but what? Twice. Nobody's been able to avoid. Nobody's avoided 2000 and 2008. Nobody avoided 2000 and 1987. Nobody's done that. There's been lots of advisors that avoided one. They get the big press, but you know what happens? They're not able to avoid the next one. So not only consistent, not twice. They haven't been able to do it twice. So keep calm. Don't expect too much. Invest for growth and invest for safety, but never shall the two mix. See, the future is unpredictable. As changes have causes we didn't include in our calculations or haven't ever even heard of. Do you get what does this mean, guys? The future is unpredictable. As changes have causes we didn't include in our calculations or haven't even heard of. It's hilarious. It's hilarious when all the experts tell us why the 1987 market crashed. And then it's hilarious why they tell us why the 2000 crashed. It's hilarious why they tell us how the 2007 crashed. Really? Really? They can tell us now why it crashed? Well, if they were so smart, why didn't they tell us what, guys? Yeah, why didn't they tell us before, Tony and Dino? And why can't they, guys? Why can't they tell us before? Because of what's up on the screen right now. The future is unpredictable. Changes of causes didn't even include in our calculations or haven't even heard of. We don't know what's going to happen tomorrow, do we? We have no clue what's happening tomorrow. So, anybody for a game of Russian roulette? Sure, my record is 67 wins and 4 losses. Is that going to help you with Russian roulette? Guys, here's the Russian roulette. You got one bullet out of 6 in a chamber, right? So, six-gun revolver, 1 bullet. 5 empties. So if you start out, and this shouldn't be dollars, I'm sorry, this is people, not dollars. So this dollar sign should be people, it's not dollars. So 6,000 people start out, 16% of them lose, and again, no dollars here. It means you have 1,000 people die, 5,000 live. So these aren't dollars, guys, these are just people. So you start out with 6,000, you're down to 5,000. Then you're to 5,000, you're down to 4,000. But by the 15th play, we're down to what? We start out with 6,000 people, and what are we down to? How many people? So we started out with 6,000 people, and after playing the game 15 times, we're down to how many people? Somebody help me to make sure we're understanding what's going on. Yeah, 348, 389. So here's the thing. That's about 6%. So after 15 games, we're down to 6%. So would we say that those 6% are awesome? They figured out how to play Russian roulette. They get it. They're just better players than everybody else out there. Yeah, it's pure luck, Trevor. It's pure, unadulterated luck. So that means that 6% of the people could have won 15 times in a row, but that's not skill. That's luck. So what's my point here? Well, here's my point. According to the S&P Standard & Poor's Dow Jones study, out of the 2,862 actively managed U.S. stock funds, those funds that ranked in the top 25% for a 12-month period, how many do you think stayed in that top 25%? Out of 282, so the top 25%, what would that be? About 500, 600, 700 funds, right? Would have been in the top 25%. How many do you think? How many ranked in the top 25% of the four subsequent 12-month periods? Two, which means we're at not 1%, not at 0.1%, but at 0.06% of them managed to do that. So you know what? Are they better or worse than playing Russian roulette? And what do you think the likelihood these two are going to be there going forward? Because in order for them to be better than everybody else out there, they have to what? In order for somebody to beat the market, you have to what, guys? Take more or less risk? Yeah, you have to be lucky, Bruce. You have to take more or less risk. Because remember, not only do you have to beat the market, you have to beat everybody else. Because remember, the market is a zero-sum game. What do I mean by that? The market is a zero-sum game. What do I mean by that? For every winner, there's a loser, right, Bruce? For every winner, there's a loser. So you constantly have to beat everybody out there to beat the market. And again, 75% of the market is who? The big institutional investors that have unbelievable brain power, computer power, and everything, and buying power. And guess what? Who gets the information first, guys? Who gets the inside information first? Us or those 50 big shots? Those 50 big companies? They do. So for us to be, so it's a very difficult thing to do. I mean, we talked about hedge funds before. How many of them are still around? I mean, they were the hot thing. I had so many people in the mid-2000s tell me, yeah, you know, I've got my clients at hedge funds. Yeah, hedge funds are the next thing, blah, 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 blah. How many hedge funds are still around? They're all gone. In fact, Research Magazine found a vanilla 60% stock fund, 40% bond fund, killed hedge funds over the last decade. Killed them. But then a lot of people say, well, hedge funds, though, they're designed to hedge, right? Because if you look at hedge funds are at 7.1%. S&P 500 was at 8.78%. So they didn't. I mean, they killed them. But then how about hedge funds? Because remember, hedge funds were designed to what? They were designed back in the 1960s, and they were designed to not get high returns. They were designed to hedge your bets so that you wouldn't get the highest return, but it would protect against downsides. But here's the thing. Remember what we started out with? Don't expect too much. So hedge funds went from what they were supposed to be doing, which is increasing security and setting limits, and instead they started to do what? They expected too much from hedge funds, and the people started to think they were going to do what? Make tons of money. Don't expect too much, guys. Don't expect too much. See, they didn't hedge. They didn't hedge at all. They got killed. So am I saying put all of your money under a mattress? Put it all into guaranteed. Is that what I'm saying? No, because we already said we need to keep ahead of inflation. But for our retired clients, are we using that growth money to stay ahead of inflation, or are we using it to get rich? You know, one of the things that drives me bananas is with the fixed side is somebody will say, well, on the fixed index annuities, they don't make a ton of money. Why do you think I'm not concerned with fixed index annuities making you a ton of money? Even though I don't totally agree with that. But why would I not be concerned if fixed index annuities didn't pay you a ton of money? That's right, Bruce. That's right, Trevor. It's not their purpose. That's not what we're using them for. What we're saying is fixed index annuities are the highest rate of return you can get on a guaranteed side for the guaranteed half of the portfolio. So if we were saying use the fixed index annuity for the growth side of the portfolio, then that would be a problem. But we're not. We're using the fixed index annuity for the guaranteed side of the portfolio, which means it's the, and there's not anything out there that's going to give you a higher rate of return on the guaranteed side than a fixed index annuity. So now that you've got that, you've got the highest fixed side going on, then you can go out and look at how to get a good return on the growth side. Because we need balance, right? We both need both safety and growth. That's why for retired clients, I love to see that 50-50 portfolio. It's the same thing that Graham said that we should have. And if you don't know who Graham is, then you need to get the book, The Intelligent Investor. He's the mentor to Munger, to Gross, and also to Warren Buffett. So he mentored all three of those guys, the giants of today. So 50-50, good enough for Benjamin Graham. It's good enough for our clients, and that's why I like to see that. So now let's talk about AUM though, because there's a problem for you guys that are AUM managers, and we need to be. And I want to help you, even though I don't get paid for your AUM money. I want to help you with your AUM money because that's going to help you have successful businesses. So the objects in the mirror are closer than they appear. And what I mean by that is I don't know if you looked over your shoulder. If you do AUM, I don't know if you looked over your shoulder, but I've given you a couple of shots over the bow here in the last year. You've got some problems coming up. Oh, what's the name of the author of that book? It's Benjamin Graham, The Intelligent Investor. It was written in 1929, I think. Or was it written right after, or maybe 1932, and then it's been republished several times since. And if you haven't read that book, you should not be recommending any investments to a client. So the market, what's happening to people who do manage money, whether they know it or not, is they've got competition coming at them fast from behind. And this competition is competing how? The same way Walmart and Target put grocery stores, put mom and pop hardware stores, put the five and dime under. How are they doing it? Somebody else wants the name of the book again. It's The Intelligent Investor by Benjamin Graham. And Benjamin Graham was the father of financial analysis, and he mentored Buffett, Munger, and Gross. So the problem we have if you're managing assets is the big guys are starting to come after you. They're coming after you what? Quality? No, because everybody, I hope you're understanding, ain't nobody going to beat the market for long. Ain't nobody going to beat the market with less risk more than once. So the robo-advisors, right, Lyle? It's the attack of the robo-advisors. So right now the players are these, and here are the what they're charging people. I mean, oops, I want to go back to that. Sorry about that, guys. That's significantly less than what you guys are charging. And if you guys are charging 1% and their manager charging 1%, so you're charging 2%, you guys are sunk. Why would anybody want to be paying 2% when they can get this? And here's the thing. These guys are saying, we are here to disrupt the financial planning space, to arm the Americans with access to financial progress. Disrupt is a huge word. Those of you that have any business education, any MBA business education, what does disrupt mean, guys? What does disrupt mean? Alter, yeah. Basically, they're coming in to change the landscape of how things are done. iPods were disruptional to the music industry. Why? Yeah, Genie's right. Destroy is basically what it's saying. Destroy the financial planning. See, so here's what's happening. Right now, these robo-advisors currently have $11.5 billion, which isn't a lot. But that's happened in the last couple of years, last 2 years. So that's a lot for 2 years. That's an awful lot for 2 years. But the scary part is this. Guess who's now paying attention to these robo-advisors? Anybody have an idea? Who's paying attention to these robo-advisors? Clients, insurance industry? Well, the SEC? No, because they're not. I mean, here's the thing about these robo-advisors. They're the most ethical as you can possibly get. Let's see. Nobody's got it yet. Here's the scary part. Venture capital has piled $294 million into these robo-advisors. Why? Because they see it as what? A growth industry or a dying industry? A growth industry. So the fact that the next big thing, exactly. So as these private capitalists get into this and start funding it, you're going to see a lot more commercials. You're going to see a lot more push. You're going to see a lot more everything. And in fact, they scored a big a win here. Why do you think I have the San Francisco 49ers on here? Anybody know why I have the San Francisco 49ers on here? They lost. They signed a big deal with Wealthfront, which is one of the wealth managers. So they made a huge deal in that they now recommend all their players use Wealthfront, and Wealthfront's going to be advertising that all over. So when you start to get mainstream like that, that's going to be a problem if you manage money, especially if they're managing or if they're competing on fees. And guys, how sensitive are clients to fees nowadays? Who talks about fees to them? Who talks about fees? Do magazines talk about fees? Does Susie Orman talk about fees? Does Dave Ramsey talk about fees? Does every possible entity out there talk about fees today? Yes. And when you're looking at fees that look like this, how does that compare to what your current fees? And do you really want to charge these fees, guys? Can you physically afford to do assets under management if this is what you're charging for fees? Could you possibly afford to do it, assets under management, if this is what you're charging for fees? Be crazy. You'd go under. You'd be under, and I'll show you why here in a second. See, and here's the thing. So Wealthfront now is working with the 49ers, and this is happening over and over and over. So the big guys are not getting into. Vanguard is testing a personal advisor services. So they actually even have, they're not even robo. They're using a real Vanguard human, and they're charging 0.3. They're just starting to roll this out, testing it right now. So now you've got you can't even say, well, at least you have a human being. Well, they have a human being. And is Vanguard a trusted name or not? Is Vanguard a trusted name or not? It's a hugely trusted name. Charles Schwab is testing the same thing. So now you got Charles Schwab and Vanguard looking to do an end run around who? Well, Vanguard's been doing it forever, but Charles Schwab is now looking to do an end run around. They were supposed to be our friends as advisors, and they're looking to do an end run around us. Why? The same reason. Why does Allstate own E-Insurance? Or E-Insurance, whatever the heck they call themselves. They're doing an end around their own. Why? Why did Allstate buy E-Insurance? Because it doesn't, don't you think that upset all of their agents? So why did they buy them then? What's the future? Straight to the company, right? So we need to be aware of this happening, but see, all is not lost. Here's a piece that really you should take to heart. See, money management to owners. Here's the thing: small AUMs, their revenue is only $246 on average. Small AUM owner, so a small asset money manager revenue is on average $246. A large one's average is $726 a year. But look at this: income per dollar is 61 cents per dollar versus the large at 43. Why is that happening, guys? See, the small asset managers has a 42% higher profit margin than the large AUM. Why? Why is that happening? Why does the small one have a higher profit management? Aha, John, you got it, and Brahma got it. That's right, and Tony. Okay, you guys got it, and Todd. Yeah, it's the large AUM has a lot higher overhead, and the larger money manager. Guess the larger money manager. How much do you think they put in guarantee type products? Or are they trying to have everything in assets under management? They're trying to have everything in assets under management. You know what? That's a two-edged sword. Because when things are going great, guess what? It's great. But when things go horrible, how horrible does it go for somebody that has all their clients' monies in securities of one's? And remember, how are bonds operating? Are bonds really a good hedge for stocks nowadays? Or are they all? What did we just talk about? What's happening to diversification, to correlation? So they all act the same. So what they're hoping is they can beat the market, right? Beat the market, but then also get out before. Guys, why is it impossible to get out of the market in time? Because remember, in order to get out of the market in time, you need to sell, which means you need to find what? Well, you don't know when. I would absolutely agree with you, Brahma. Well, if you're getting really selling signals, well, if you get selling signals, who else is getting selling signals, guys? In order to get out, you have to what? Find a buyer. If nobody's there to buy, guess what? I don't care how smart you are, what's going to happen to your accounts? They're going to get killed. So having certainty, having half your client's money and guaranteed gives you what? A lot of breathing room, because you can basically, you're competing against computers located next to the trading floor, Eric. You're exactly right. That's the thing. Just to get, see, it's impossible for us to beat those guys. So why then are why is a small money manager able to beat a large money manager? For one thing is overhead, which you guys have said. Overhead, employees, systems, software, marketing. I mean, I personally know guys that are making $1 million a year in money management, and guess what they net? Make $1 million a year in money management, and guess what they net in their pocketbooks? What would you guess? I know 2 guys like this. 100,000. Well, not 10. Yeah, 10K. No, they're netting over 200, between 200 and 250,000. But guys, I know guys in our industry that are netting 500,000, and guess what they're pocketing? 350, 400. Yeah, so you know what? And it's because of the way they're managing the business. Having a small practice, you have advantages that nobody else has. And one of the big things is when you have all their money in the market and you're trying to manage the risk and the return by having all the money in the market, guess how much time you're going to spend with a client? Yeah, a ton. Exactly, Tony. A ton. But when you have 50-50, when you have 50 in absolute guaranteed and 50% in the market, and you've had a conversation, the reason we have 50-50 is this money is you're never going to lose a dime. This money is going to grow, and by grow it means some years are going to be up, some years are going to be going down. Guess how much time you have to spend with your customer at that time? A lot less. A lot less. I mean, Remember, I had my practice during the 2000 crash, and I wasn't meeting. None of my clients called me up worried. Why? Because we'd had this discussion a long time ago that we got half your money in guaranteed and half your money in market, and it goes up and down, and they were fine with it because they knew, because I prepared them for that money going down. I never tried to tell a client, you know, I'm so smart that I'm going to make sure that when the market goes down, we're not going to go down. Oh, what an idiot would say that. Instead, guess what I told my clients? Hey, you know what? When the market goes down, you know this half over here? When the market goes down, guess what's going to happen to this half? What do you think I told them? Did I tell them that I was going to manage it and get it out in time? What did I tell them about their growth side? That when the market goes down, guess what's going to happen to this half? What did I tell them? It's going to go down. It's going to go down, exactly. And I said, that's why we're doing what, guys? So then I would explain. So then, folks, so why? Why are we okay with this side going down? Because this side is going to what? Be guaranteed. The guaranteed side is going to be guaranteed. Because here's the thing, guys. When you start to study, when you start to really study and look at the history of guys that have tried to beat the market, yeah, you can get a selling signal. You can get a selling signal to get you out in time, or at least mitigate your losses. What's the big problem with that? You can get out and preserve, you know, using moving averages or selling signals. You can get out in time to mitigate some of your losses, but there's a huge problem with it. Yes, when to get back in, Casey. Getting back in, and other people are saying, yeah, and everybody's getting the same signal. Absolutely right. So the problem is getting out is one thing, getting in is another thing. So you not only have to be smart enough to get out before everybody else gets out, but you also have to be smart enough to get back in before everybody does. Guess who's ever proven they can do that? Nobody. So you really eliminate all the problems you have with managing your clients when you say, listen, on the equity side, this is going to go up and this is going to go down. But what we do know about the equity side is going to do what? It's going to go up or down, but what do we know about the equity side? Over time, it's going to do what? Over time, it's going to go up, Alan. Over time, yeah, guys, it's going to go up. So we don't want to get in the game of trying to guess when to get out and when to get in, because what you've seen the charts, right? If you just miss like 30 of the best days of the market, you lose over half the return. If you over the last 10 years, if you just miss 30 of the best days over the last 10 years, you've removed 50% of your return. That's huge for 30 days. So we don't want to miss those 30 days. So what we want to do is make sure that we don't miss those 30 days because that would harm us. So we're going to ride it up and down knowing that over time the market's going to go up. Because if we don't believe the market's going to go up, then we shouldn't buy stocks. We should buy what? Beans and ammunition. And I'd actually tell them that. So if we don't believe the market's going to go up, we shouldn't be buying stocks at all. We should be buying beans and ammunition. But when the market goes up, we don't know how it's going to go up. We know it's going to go up and down, up and down, up and down. We just know over time it's going to go up. That's why we have some of our money in growth and some of our money in guaranteed. What does Warren Buffett think about the stock market? Does Warren Buffett invest in the stock market, guys? I mean, he's really, can we agree, Warren Buffett is the only guy that's beaten the market over the last 30, 40, 50 years. He is a god when it comes to the market. But how does he view the stock market? Optimistic? No, he does not. Guys, he doesn't invest in stocks. What does Warren Buffett invest in? He thinks buying stocks is idiotic. He doesn't think anybody should be buying stocks. What does he think people should be buying? Not options. Businesses, Bruce. Right. Gene, Fern, businesses. Invest in companies. And if you're investing in companies, do you care what their stock price is? Yes, you want to buy it cheap. But after you buy the stock, do you care after you buy that? Does Warren Buffett care about the stock price after he buys a good company? No, Bill says. You're exactly right. He says, I buy a company with the mindset that the stock market is going to shut down for the next 10 years because I don't plan on selling that company for 10 years. I'm not going to buy a company that I don't think is going to get better over the next 10 years. So he thinks buying stocks is just as bad as going to Vegas. Because when you're buying stocks, what controls stock price, guys? Emotions, right? Fear, greed, emotions. Boy, that's how are we going to manage our money if it's based on people, crowds of people buying things on emotion and selling things on emotion? That's impossible. So instead, what Warren Buffett does is he buys companies because he believes they're going to grow over the next 10 years. So what do you think my belief is? I buy stocks because what? I buy indexes because I believe in what? I don't know what. I'm not smart enough to be Warren Buffett to decide what company is going to be here 10 years from now. But what I do know, and that's right, Bruce, long-term growth. I do believe in the U.S. economy. I do believe in the economy of the world. I do believe that the economy is going to continue to grow. I don't think it's going to grow like it has in the past, at least not in the U.S. or the Western countries or developed countries, but I think it's going to continue to grow. And I believe in that. I don't think we're going to go backwards. I think we're going to go forwards. But I'm not going to bet on which company is going to do it and try to get in and out at the right time. I'm going to have half my money in guaranteed and half my money in growth. And since I don't know what companies, I'm just going to go in the index. Now, I'm not telling you why or how to invest. I'm just saying, guys, don't expect too much. Expecting too much is believing that you're going to pick the right stock at the right time and get out at the right time and blah, blah, blah. And nobody's been proven to do that. The best investor that's living today, Warren Buffett, wouldn't do that. And hey, if you guys think you're smarter than Warren Buffett, then you really shouldn't be on this system, should you? Where should you be? And if you've got a money manager who's smarter than Warren Buffett, you shouldn't be on our system. Where should you be, guys? Yeah, buying his company. Exactly. You should be buying his company. And retired on an island. I like those ideas as well. So does that make sense to you guys? So I love stocks. Just don't expect too much of them. Expecting too much is expecting that you're going to be able to get into them at the right time and out of them at the right time. That's impossible. So instead, tell your clients, listen, this is our growth. We believe in long-term growth. We don't believe in short-term growth because we don't know what's going to happen tomorrow. But we do know what's going to happen. And you know what? We don't even know what's going to happen in the next 10 years because of what happened between 2000 and 2010. But we do need to keep ahead of inflation, so we do have to have some sort of growth. Does that make sense? So any questions, concerns before I cut you loose, guys? Good. So one thing before, those of you that are assets under management people or manage money, how do you, see if you can remember this. I told you this last summer. How then do we compete with these guys that are charging so little? How do we compete? See if anybody remembers. How do we compete with these guys? 21-point checklist, I would agree with that, Tony, absolutely. Guys, if you're charging a fee for assets under management, what do you tell them you're charging? Let's say you charge 1%. What do you tell them, if you're charging 1%, what do you tell them you're charging for assets under management? Aha! Michael got it. Let's see. That's right. Tony's got it, and Michael's got it, and John's got it. So you're going to tell them that you're charging 0.25% for the asset management, and you're charging the rest of the fee, whether it's if you're charging 2% or 1%, you're telling the rest of the fee is for what? The 21-point checklist and all the stuff you're doing there. So we're giving you an advantage no other asset manager has, because every other asset manager is competing basically on what? Better advice. Guys, can we compete on better advice? No. What we know is that we don't know. So what we're saying is we're only charging the same as what these guys are charging, but we give you all this other stuff, this 21-point checklist. We're helping with your powers of attorney every single time we get together. We're helping with so you have an advantage they don't have. Because if I'm selling assets under management, if I'm selling money managers, I'd be quaking in my boots right now. I wouldn't know what I should be doing. I'd be quaking because they are screwed. Because if you're gonna compete against these robo-advisors, man, you're gonna lose. If what you're saying is that you're gonna compete with these because I've got better money management, blah blah blah, guys, some of these managers are gonna have good years, just like other managers have good years, and then your clients are going to look at that, and they're going to be advertising online that they got to look at us. We got 30% last year, and then and we only charge 0.15%. And then they're going to look at you because they're going to be on TV saying that stuff, guys. When they have those good years, they're going to be on TV saying that stuff, and then your clients are going to look at you and see, wow, well, you only made 15%, and he's charging us 2%. Why the hell are we with this guy? We need to go over to whatever. So if you are only competing as an asset manager, you are screwed. But with the 21-point checklist, we give you an advantage that no other asset manager has, which is we can say we're only charging 0.25% for managing your assets. The rest of our fee is for all the other things that we do for you. Does that make sense? So having the 21-point checklist, doing all those things that you quote-unquote don't get paid for, you can now lump those in and say we are getting paid for those things as part of that total fee. Does that make sense to you guys? So you have an advantage that nobody else that's managing money has. You should still be aware of this, but you shouldn't be frightened of this like all the other asset managers should be. Because most asset managers are so arrogant, they don't think that this is going to hurt them. Guys, what do you think? What do you think is going to happen? I mean, the music industry didn't think that didn't think the iPod was going to affect them. How quickly did it take the iPod to affect the music industry? Boom, 6 months. Because once it gets, they're blindsided, Lyle, exactly. They go like the way of the hedge funds, exactly. Okay, so does this make sense to you guys? So my whole point, all this stuff that I wrapped up to this was basically the point that two things. Don't expect too much from your equity side. Let the people know that it's going to go up and it's going to go down, and we're fine with that because we're not investing for the next 6 months. We're investing that side for the next 10 years. We have this guaranteed side that we're using for right now. Does that make sense? And there's no better guaranteed investment than a fixed index annuity for rates of return. Not for equities, but for guaranteed side, there's nothing better than an FIA for the guaranteed side. And for you that manage money, make sure you're now talking about, don't ignore this. I would start talking to people right now about how your fee is only 0.25% for the actual asset management. It says 1% here, it says 2% here, but that's only 0.25% for the actual fee management. It's the rest of it is for all this other stuff that we do. Does that make sense? Cool. Then I'll cut you guys loose. Any questions, concerns? Otherwise, I'll cut you loose a little early. And I hope you have a great week, and we'll talk to you on Friday. Looks everybody's okay. Good. Super. Then we'll talk to you all on Friday. Thanks, everybody.